When should you actually sell your Bitcoin and crypto? Right now, the crypto market is a mess. Prices are weak, sentiment split, and everyone's asking the same question: is the top already in? One camp says yes, the market's peaked and smart money is exiting before the end of the year. The other camp says no, they believe that the old 4-year cycle is dead and this will be crypto's first 5-year cycle with new highs coming in 2026. So which side is right? Should you sell now or hold through what could be the biggest melt up yet? In this video, we're breaking down exactly how to spot when the market's truly topping and how to know when it's just shaking you out. After digging through every major bull run and comparing how each cycle has played out, I've narrowed down the repeating signs that always show up before the top hits. And right now, with crypto entering what could be its most explosive stage so far, understanding those signals is critical. We're going to look at the real data, every sell indicator that appeared in past cycles, and break down what they mean today. Along the way, I'll be drawing from the insights of Raoul, one of the sharpest minds in global macro. Raoul, a former hedge fund manager and the founder of Real Vision, has built a reputation for calling cycle turns that most analysts miss. When he shares his framework for timing exits, the smartest investors take notes. The truth is, no single indicator tells you when the top is in. What matters is when several of them begin to converge. When 4 or 5 warning signs flash together, that's when euphoria peaks, and that's when the market usually rolls over. So let's break down exactly what those signals look like and how to recognize them before everyone else does. Before anything else, we have to talk about the rhythm that drives this entire market. Since its creation, crypto has followed an almost clockwork 4-year pattern, and no one has explained it more clearly than Raoul.
So as we know, crypto is very cyclical. There's a debt refi cycle that happens every 4 years because everybody reset their interest rates in 2008 to 0 and then made all of the government debts in around 4 years, 3 to 5 years. And it's created this endless cycle, which happens to be the same as the Bitcoin halving cycle and the US presidential cycle. So we're faced with these cycles. And out of 3 years, crypto is the best performing asset in the world. In year 1, crypto spring, year 2, crypto summer, year 3, crypto fall, and macro spring, summer, fall. And then year 4 is the worst. And the worst is what scars people.
Every major surge in Bitcoin has arrived right on schedule with this rhythm. Back in 2013, Bitcoin shot from under $1,000 to over $1,200 before crashing. 4 years later, in 2017, it soared to $19,000. By 2021, it reached nearly $69,000. Each of these tops came roughly 4 years apart, each tracing back to Bitcoin's halving cycle. If that structure continues, the next major peak should land somewhere between late 2025 and early 2026. Raoul connects this not just to Bitcoin's halvings, but to broader macro forces. His Everything Code framework links the crypto cycle to global debt rollovers, the United States election timeline, and liquidity waves that ripple through the entire financial system. In his view, these layers move together. The halving dictates supply, while liquidity dictates demand. He divides the 4 years into seasons. After a halving comes crypto spring, when optimism returns. Then crypto summer, where prices break higher. Next is crypto fall, the euphoric climb to the peak. Finally, crypto winter, when leverage collapses and weak hands get wiped out. Right now, we're sitting deep in the summer phase. Prices are running hot, corrections are shallow, and momentum traders are back in full force. But summer never lasts forever. As the calendar edges closer to 2026, the market will enter fall, the season of mania. That's when leverage spikes, retail traders flood in, and the charts turn vertical. Raoul expects this final push could carry into the first half of 2026, and the early signs are already visible. Gains have been steady for months, confidence is rising, and people are taking reckless bets. Credit cards, loans, and even mortgages are being funneled into crypto positions. Online, you can already see posts bragging about going all in. That kind of behavior always lights the fuse. It drives prices higher but leaves the market fragile. The moment momentum stalls, those leveraged traders get liquidated, triggering the chain reactions that mark every blow-off top. If this pattern continues, we'll be staring straight at the late cycle danger zone. Before we get into the profit-taking strategy itself, just a quick reminder, only a small percentage of you watching are subscribed. If you're getting real value from this breakdown, hit that subscribe button. It helps the channel grow and you can always change your mind later. And before we move into the exact profit-taking framework to follow, just a quick reminder, only a small percentage of you watching are subscribed. If you're getting value from this breakdown, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Next, we have one of the most consistent warning signs across every major crypto cycle. The moment the market convinces itself that it has outgrown the laws of liquidity, emotion, and time. At this stage, investors start to sound remarkably confident. They talk about how volatility will fade, how new players will stabilize prices, and how the industry has finally matured past its wild early days. Every cycle has its story. In 2017, it was the arrival of retail. In 2021, it was institutions are here. And now, in 2025, the claim is that ETFs will keep prices steady, that pensions and endowments will hold through volatility, and that crypto has evolved to behave like the S&P 500. The problem is institutions are still human systems. They follow mandates, respond to pressure, and depend on liquidity. When markets tighten, they reduce risk. When their performance is threatened, they sell. They are not immune to cycles, they amplify them. So when the market begins insisting that this time is different, it's usually the prelude to the same ending. Conviction turns to euphoria, and euphoria becomes denial. We can even track this shift through a strange but reliable indicator: App Store rankings. In both 2017 and 2021, Coinbase surged to the #1 spot on the Apple App Store just weeks before the entire market peaked. It marked the moment the retail frenzy hit its maximum intensity. Right now, in November 2025, that pattern is building again. Coinbase has been climbing fast, fueled by a wave of new retail signups. If it reaches the top slot again, history says the cycle is entering its danger zone. When optimism starts to sound like certainty, and when everyone believes that the bear market has been defeated, that's usually when it's already on its way. Another unmistakable clue that a bull market is nearing exhaustion is when capital begins rotating across the crypto ecosystem. It's the natural progression that repeats every cycle. Bitcoin breaks out first, leading the market higher, then Ethereum follows, pushing even further. Finally, money floods into smaller, riskier altcoins. That stage is already unfolding. Ethereum has been surging for months, and capital is now spilling deeper into the risk curve. The top-tier coins have already delivered their biggest moves. Bitcoin and Ethereum captured the early cycle gains and the spotlight. But when that momentum cools, history shows what comes next. Liquidity chases the promise of faster returns elsewhere. It pours into low-cap altcoins that trade on emotion more than fundamentals. These smaller coins swing wildly, offering the biggest percentage moves in both directions. It's the final rotation before the blow-off top. Veteran traders have a nickname for what comes after Ponzi season. It's the moment when the weakest projects start outperforming everything else. In 2021, it was fake yield farms, passive income tokens, and overhyped DeFi protocols. None of them survived the crash that followed. This time, as 2025 heads into year-end, the same energy is building again. AI coins, celebrity tokens, and next-gen staking models drawing in retail investors chasing quick profits. That excitement signals we've entered the riskiest stretch of the cycle. Market culture shifts with it. The builders grow quiet while influencers and promoters dominate the stage. Flexing wealth replaces real innovation. The noise spills outside crypto circles too. Friends who never cared about markets start giving price predictions. Barbers and Uber drivers share token tips, and social feeds fill with overnight success stories. In every previous bull run, this kind of mass participation has marked the top. Celebrity hype always seals the phase. When athletes, artists, and influencers start minting coins or NFTs, the market has already peaked in enthusiasm. Institutions follow the frenzy, throwing absurd sums into startups with nothing but vague roadmaps. Retail investors respond with emotional loyalty, turning tokens into identity, tattoos, avatars, slogans. These cultural extremes are all symptoms of euphoria. Even investor behavior tells the story. People who once checked portfolios weekly are now refreshing every hour. It's greed masquerading as excitement, and it shows that rational strategy has given way to emotion. Companies feed into it with massive marketing pushes, stadium deals, primetime ads, sponsorships that scream confidence right before the fall. When Google searches for cheap crypto to buy start spiking, that's the final confirmation. It means the smart money has already rotated out and the crowd is piling into whatever scraps are left. That's when the cycle is closest to ending. Now it's time to look at one of the most reliable signs that the market is approaching the end of its run. Traders who follow technical data know there are many indicators out there, but few have earned as much respect as the Pi cycle top signal. It's one of those rare tools that keeps proving itself cycle after cycle. The idea is straightforward. When Bitcoin's 111-day moving average rises above the 350-day moving average, it means short-term momentum has run too far ahead of long-term stability. It's the moment when the market overheats. This crossover has a history of being right on target. In 2013, it flashed almost exactly at Bitcoin's peak. In 2017, it appeared within 2 days of the top around $19,000. Then in 2021, it did it again, calling the peak just before the drop from 69,000. It's not magic, it's math revealing when the pace of speculation becomes unsustainable. What makes this so important is how it fits into the broader pattern. As of November 2025, the Pi signal hasn't triggered yet, which means we haven't hit that same historical threshold. But when it does, it almost always happens deep into the mania phase when most of the other warnings, retail FOMO, over-leveraged traders, and institutional greed are already flashing red. It doesn't start the correction, but it confirms it's close. So, when you finally see the crossover appear, understand what it means. It's not another hype signal, it's a warning from the data that the market is burning too hot to sustain itself. And every time that has happened before, the next chapter has been the same. The euphoria fades and the cycle resets. Once those warning signs start appearing, the big question becomes how to actually handle selling. It's one thing to recognize a top forming, it's another to know how to act without letting emotion sabotage your decisions. Well, to answer this, here's another clip from Raoul.
Here's my suggested path for most people, and maybe something I will do this time myself, is we don't know what the cycle peak is going to look like. We don't quite know when it's going to be. We do know it would be crazy early if it finished this year. Usually, the back part of the year after the US election, there's usually a screaming pump into the end of the year. So my advice is use that in terms of time and not price. And take maybe a third off the table for lifestyle chips. Okay, now you can buy your car or your house if you're lucky or whatever it is, or some extra savings, right? Take some money out of crypto land, put it into fiat world where you live, secure your lifestyle, the things that matter to you. Right, now you've taken all of the pressure off. You've done it via time and not price, which is towards the end of the year, I'm going to take a third off. I don't really care what the price is because it will be up a lot. So I'm just going to take it off. And then now I've de-risked my life so I can now run 2025 more intelligently.
Raoul often explains that the hardest moment to sell is when it feels completely wrong. When your feed is filled with bullish headlines, when every influencer is shouting, "This time is different," and when your gut tells you to hold forever, that's usually the signal that it's time to take something off the table. The point where selling feels crazy is often the exact point where it's right. This is the foundation of Powell's 2025 exit framework. His approach rejects the idea of hunting for a perfect top. Almost nobody sells right at the peak, and those who try often miss the rebound entirely. Instead, he focuses on time windows rather than price levels. For this cycle, that window stretches from late 2025 through the first half of 2026, which historically aligns with the most volatile and profitable stretch before a reversal. His personal playbook is built on balance. During that window, he plans to take around 1/3 of his holdings off the table, his lifestyle chips regardless of the price. That move secures freedom and relieves emotional pressure. The remaining 2/3 stay invested to capture any final surge, with flexibility to sell another portion if the market goes vertical like it did in 2017. The key is he never exits completely. Keeping a core position ensures you stay exposed to the long-term trend and aren't left watching from the sidelines when the next cycle begins. Powell learned that lesson the hard way. In 2013, he sold near the top and tried to time the re-entry. If he had simply held and accumulated more during the bear market, his returns would have been roughly 25 times larger, and exponential assets like Bitcoin holding through pain and adding at extreme lows compounds far more effectively than trying to trade every swing. As we move deeper into 2025, this means building your plan early. Map out your exit window, monitor the major cycle indicators, and prepare your targets before the crowd starts reacting. The next few months are when discipline separates the investors who keep their wealth from those who give it back. From there, lock in your exit window. For most investors, that should fall between November 2025 and February 2026. Decide your lifestyle chip number early so greed doesn't cloud your judgment when the time comes. Once you've secured that, start preparing fresh capital for 2026 because the next bear market will offer the kind of discounts that built fortunes in every previous cycle. The opportunity doesn't disappear, it just shifts to those ready with cash when everyone else is exhausted. We're entering the banana zone now, the stage where gains turn vertical before evaporating faster than most expect. Watch the indicators, respect the rhythm of the cycle, follow the plan that keeps you positioned for the long haul instead of trapped in short-term emotion. Tops are always born in euphoria, and euphoria always feels safest right before it breaks. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.